Hi, Max Rock with MultifamilyGeeks.com, here to discuss cap rates with you over the life of a purchase of a multifamily property. So what we're looking at here is our free portfolio, we call it a MFG portfolio trainer underwriting template. This is beta version 3.22. I want to show you a couple features here, and then I'll go to another one and show you one in another video. But this one is about cap rates. So imagine we're buying a property, and look right here, this property's got a 14% return and a 19% project return. This is a real property, by the way. It's not exactly the price they want for it, and it's not exactly the returns we want. It's almost there. We do find these every day. They are out there, even in the hottest markets, like right now, they're out there. So this would be one that is a potential deal, right? So let's look at the hold time. As this underwriting template allows you to adjust hold time between 1 and 10 years. Watch the IRR up here for both the LP investor and the project returns as we adjust it. It's at 6 now, right? Let's start at a 1. A 1-year hold, negative, right? Oh, let's make sure and turn off the refi. The refi is set at 3 years. Let's turn that off, just so we can sort of be in isolation of too many variables going on. So at 1 year, it's a negative return. We can't hold at 1 year. Let's try 2. Notice the reduction in the negative returns. We're down to a negative 8% right now, only with a 2-year return. So we could conceivably, if we had to, under emergency situations, we might be able to sell this in 2 years, right? And this is under the assumptions of the template, and that's what I'm going to get to in a minute here. Let's do a 3-year hold. All right, now it's at 7% return for the LP investor, 8.56 for the project overall. 4. We've jumped to 11.51. We definitely want to hold it 4 years if we can. Let's go to 5. Gets even better, 12%. Let's go to 6. Gets even better, to 13%. Now, I want you to watch the diminishing returns as we start to get far out from the purchase. So it's kind of like a normal curve, you know, a bell curve, where it's a hump in the middle, right? You're going up the curve, returns are getting better. There is a point in the roller coaster where you start heading down the hill, and the returns diminish. So let's try year 7 and watch the returns. It's going from 13 to 13.48. See how small that increase was? I would argue don't hold it for 7. 6 years is the break point there, where you're seeing the model tell you hold it for 6 years, right? Don't go to 7 unless for some reason you had to and things change, right? And that would be a different scenario. Let's go to 7. See, it continues up. Let's go to 8, I mean. It continues up, but ever in a smaller amount. This would be diminishing returns. I would argue you're on that other side of the roller coaster, where holding it long term doesn't make sense. That's why we buy, fix up, and sell in a time period, because it's better returns. Let's go back to 6 at 13.28. Now let's add in the refi. So let's turn on the refinance here, yes. So notice the numbers jumped again by refiing. What does refi get you? It gets you another 24 months of interest only. I'll tell you that. This is refiing at the end of the 3rd year. Notice you can shift when the refi is. Let's try year 4. Nope, went down. If you're going to refi, refi in year 3. Let's try year 2. 14, but not as good as year 3. Year 3, under this hold term and these conditions in this model, year 3 is the best time to refi. We've got it set at a 4%. We don't know what interest rates will be 3 years from now. We're guessing. And then the other big issue here of these 3 factors. So focus up here on cap, right? Cap rate. And by the time you look at this model, it might be slightly different, okay? So this video, but it'll be on the model somewhere, because this is important to us. There's a purchase cap. In this case, it's 7.3, calculated based upon the purchase. Now you're talking about what is the cap rate at refi. See it down here, 7.61. And you're talking about the exit cap right over here at, here's our exit cap, 7.9. These cap rates set the value at which you can refi and the value at which you can sell, and in essence sets the projections of the entire model. Now, let's talk about what's happening, because notice right here, see this right here, cap rate expansion per year. I want my model, as I shift the hold term to 6 years to 10 years, in fact, watch the cap rate here at exit. Watch the exit cap at 7.9, change it to 8-year hold. Boom, it changed to 8.1. This is good. And a lot of models don't do this for you. I would argue we're one of the few underwriting models where we have this as a component feature. In other words, you'd have to go manually adjust that exit cap. And here's the theory to me. All right, and again, you're going to have different opinions on this, right? So this is my opinion at the moment. I reserve the right to change my opinion too, which happens over time in an industry, you guys. But at the moment, here's the idea. 7.3 is a cap you're buying at. Not bad, kind of conservative. I would say the closest you get to a 10 cap, the more conservative it gets, right? In my lifetime, I've seen properties, multifamilies trade at 10 caps. I've seen it, even slightly above that. I've also seen it trading right now at 4.5% in some markets where we're making offers in, right? So here's the thing. If you start at 7.3, I want this to creep up to the sale. And a lot of people will tell you there's a rule of thumb. Just add 1.5 points to your entry cap to get your exit cap. I don't like that if you're starting high. In fact, if you're starting up at 7, I'd rather it creep up more like this. If this were starting at 4, then I'd like it to creep up more aggressively. So not creep up, but move up more aggressively. So here's we have a cap rate expansion control. Right here it's set at 0.01. Notice the returns. Let's make this more aggressive. Let's increase it at 0.5% per year. Boom. Look at how the returns drop. And look at now we're selling at 11.3 cap. Now that's not fair for this property if you ask me. So I would not do that on this property. However, let's talk about buying at a 4.5. If you buy it, and by the way, I want this to adjust. If you say 8-year and go back to a 6-year, I want that to come right back to where it should be at a 0.5 point growth per year according to this expansion factor. And if I change my refi to say year 4, I want that to adjust my cap rate to reflect what we think is happening over time. We're becoming more conservative over time in terms of the cap rate. All right, so that is a part of this model, and you can control it. You can control the expansion. So now let's go back to, let's say we buy it at a 4.5. And then we refi it 3 years, and then we sell it 3 years. So you got an entry, right, purchase. You got a refi and an exit. And say they're roughly, the refi is middle of a 6-year hold, right? And then you can just make the adjustments in your mind as we go. If you start at a 4.5, I'd like to see that growth rate be a 0.5% per year. I'd like to refi in 3 years, not at a 4.5, but at a 1.5 points higher, because it's 3 years times a 0.5 point. So I'd like to see it at 4, 5, at 6%. I'd like to see the refi. And then if I sell 3 years later, I'd like to see it a 1.5 points higher than that, because it's increasing a 0.5 point per year. So I'd like to sell it at a 7.5. That to me is reasonably conservative, and it's reasonably realistic. If you're buying at a 4.5 cap, do we really think 4.5s are going to last for the next 6 years? It's not likely, would be my only answer. We're playing a probability game here of what's going to happen in the future, and not all of our crystal balls are broken, so to speak. What we're trying to do is manufacture the deal for our investors so that when things change, we're ready and we understand the likelihood that things will change. All right, so I would argue that under this model, just be careful with it. You get to set it, and this is a little bit of an advanced feature, right? If you're a newer underwriter, you might not get this at first of what this beginning, middle, and end cap would be. And it's adjusting the cap for the refi based upon the number of years you set, and it's adjusting the exit cap based upon the number of years you hold. All right, so at 7.3, I would go for a smaller expansion coefficient, right? I would go for a 0.1. Notice how that bumps up, because before, when we first started looking at it, I had entered my own at 0.15. It's not even on the pop-up, I just guessed. 13% for LP investors. So this is fair to me. 6 years from now, I'm ready to sell at an 8.2 cap. Let's say worst case scenario is it's a 10. I may still, I may still lose my shirt, so to speak, but I'm not losing it as much as if I didn't predict these expansions on some coefficient, some constant that expands it per year of hold time / refi money. Some year, what do they call it? The time value of money. There we go. Sorry, you guys, sometimes my brain won't click into gear. So just so you know it's there, it's called a cap rate expansion per year. It might be in a little bit different place when you find it. You should see some heads up of what are we buying at, what are we refining at, and what are we exiting at for the model and the settings as they are right now. Okay, hope that helps. Max Rock with MultifamilyGeeks.com. Thanks, you guys. Bye.